Tony, thanks so much for being here with us in Denver.
Thanks for having me.
So tell us then, with the big drop in gold in April, we saw another hit in June. We've seen a trading range between 1,200 and 1,350, maybe 1,400 tops, but it's definitely a different gold environment. What kind of changes are you guys bringing about in your cost structures at Royal Gold for that?
Well, the beauty is in our cost structure, we're a royalty or a streaming company, so we don't have a huge amount of cost structure. 90% of our cash flow drops right down to our EBITDA line. So we only have 21 people in a company that has over a $3 billion market capitalization. Very, very efficient. So we don't have that issue about margin compression and those kinds of things. We still have a very healthy margin in our business. But what we have done is when we look at new transactions, we certainly want to buy assets in this price environment that can make money at this environment. So we're not looking for gold price appreciation to have a reasonable return on our investment.
Investors who are looking for growth in companies, they come to royalties or streaming. How can they tell that there is growth potential in your company?
Well, look, we have all the same fundamentals that a mining company has, except we don't have the risk. So when you look at our royalty, our stream and interest, they're geographically defined. So when we invest in a property, we don't just look at it from the standpoint of what the reserves are today. We really want to understand where is that deposit going into the future. And so we'll take a very strong position on resource conversion into reserves. And we've had a tremendous amount of growth. We can just give you one touchstone, a Peñasquito property that Gold Corp is operating in Mexico.
Right, yeah.
We bought that royalty from a company called Rio Tinto for $100 million, and today, with the growth that's been experienced at the property, our carrying cost is only $100 an ounce, whereas you say the gold price is running right around $1,300 an ounce, a little bit higher than that. So very, very good margin in a business like that. But we bought it right. We really looked at it hard, wanted to get associated with an asset that had good upside potential.
You mentioned property, and you go in and you essentially finance property purchases. Why is that a good move? I mean, like if a junior miner that you have gone in and provide financing for goes bankrupt, do you still hold the rights to that land?
Well, look, in different countries, the law is different. Okay. Some places, the minerals are a sovereign ownership and the private entities can't hold them. So we have to be very careful wherever we go to invest. But we're always very, very careful to put together programs or finance packages that aren't so ominous that if something happens to the current owner, a subsequent owner would be interested in picking that property up and going forward. And our major interest is to make sure our interest in that property transfers into the next ownership. So we're very careful. We structure things contractually around that. When we can, we look for real property interest, but you can't get real property interest necessarily in every country around the world.
In general, if you look at headlines for Royal Gold this year, not too bad. I mean, you've had a number of publications come out and call you one of the better small growing companies. Goldman Sachs just launched doing research and analysis on your company. Do you see that as a positive, or do you see that as kind of a challenge?
Well, look, I think there's plenty of growth in Royal Gold for a whole bunch of different reasons. First of all, let's talk about the assets that are already bought and paid for in our company. We have two major pieces of near-term growth. One is Mount Milligan, a mine in British Columbia that Thompson Creek is bringing online. We think that has the potential in the very near term, I'm talking about the next 12 to 18 months, to be about a 50% addition to what we have in the company now on a gold equivalent basis, so a large component of new growth there. We also have a property called Pascua-Lama that's a bit further out, about mid-2016 is when that one's due to come in. It's Barrick's property in the border of Chile and Argentina, and that's going to bring another good piece of growth in for our company. But I think here we are in a time in our company maturation that we have. We're still on the steep end of our growth curve. We're not too big that we can't buy things that are material, and I think we're going to be able to do deals in this environment with our current cash position. It's going to be very attractive to our shareholders going forward.
So then that positive press or positive attraction that you guys have seen, you've more embraced it than seeing it as a possible
Absolutely.
pitfall.
I think there's plenty of runway left for the company.
Let's turn to taper talk real quickly. Federal Reserve came out last week, said we're not going to taper. And obviously this is a big deal for rates. How have you guys seen it as an effect for you?
I think a lot of the stronger economy, the pulling back of stimulus packages has largely come out of the gold price in April and May. So I think now we're starting to find a good foundation, and the market is starting to come back into the fundamental business. One where we have to be cautious about how much further could gold actually drop before the supply side, the mine supply side, actually is impacted. So I think we're there in kind of a thin margin on the downside, but yet lots of growth potential on the upside once we get a little more confidence in the marketplace.
Well, Tony, thanks for taking a few minutes to chat with us about it.
Joe, I appreciate the time.